All right, for the third video, we're going to take a closer look at the fact pattern and how these numbers actually make their way onto the K-2. So to start with, we're going to go back to page 1 of the 1065 and look at the consolidated and the individual financial statements for each of the subsidiaries. So remember, page 1 here, this shows all the ordinary trade or business earned by both subsidiaries at a consolidated level. But what you'll notice here, and this is the issue, which is why K2 and K3 came into light, because there's no indication here what's U.S. versus foreign source. There's no indication what's U.S. source income subject to withholding, right? We don't know what portion is ECTI allocated to non-resident partners. All we see here are the totals: total trader business gross receipts, total trader business expenses, and then we have a $205,000 724 amount that's allocated to the partners on Schedule K, right? So that amount gets split between the two owners. But again, when they receive their K1s, they have no idea, just looking at the K1, what portion is going to be U.S. source, what portion is foreign source, what's effectively connected income and what's not. So if we look at Jane's K1 here, for example, she can see, okay, I got allocated $102,862 of profit. I got $43 in interest income. That's great. But on page 1 here, there's no indication what's what, right? She doesn't know what portion of this is U.S. versus foreign source. She doesn't know what portion of this is U.S. versus foreign, okay? That's where the K2 and K3 come in so handy. Now, if we go back to the financial statements, what we're going to see is that the activities of the U.S. The US LLC in Florida, so this, the fake Florida LLC financial statements, this is the income that's going to be treated as U.S. source effectively connected income. And so the net earnings that are allocated to Jane, that's what's going to be subject to withholding tax. The net earnings allocated to John, not subject to withholding, right? So, because it is effectively connected income, but it's not allocated to a non-resident. It's being allocated upstream to John, who's a U.S. citizen. And so with the Swiss entity, we're going to see the opposite, right? We're going to see this treated as foreign branch category income, which is being allocated equally between the partners. And then each of the partners is going to share equally in the amount of income taxes paid as a foreign tax credit, right? Okay, so let's go back to the return and let's actually start looking at K2. So I'm going to jump all the way back up to K2 here. So K2 is you file one K2 with the 1065, and this is the summary of items that are then allocated to each owner on K3. So K3 goes with the individual K1 package, K2 goes with the 1065. So if we just cover some of the highlights here, in section C, this is quite simply asking us, did we complete the part? If so, yes. If we did not complete this part, check box no, and don't attach it to the return, right? You remember from the slide deck, we're only completing 4 of the 12 parts here. So we have parts 1, 2, and 3, and then part 10, which covers the foreign partners' character and source of income. So that's where we see the ECI versus non-ECI issues. Now, in part 1, they ask us that you might not have any checkboxes in part 1, or you may. Part 1 is asking us, okay, if we have these items that apply, there's no section or part that covers it, but we do have to maybe attach additional information. So for example, the foreign tax translation number, that would occur if you have foreign taxes paid in a foreign country and you're going to pass them through as credits and you need to translate those amounts into US dollars. On the K2 itself, we're just reporting everything in USD. But because we have translated amounts from a foreign currency to U.S., we have to indicate as such here and then attach a schedule that shows how we came up with the conversions. Right? Same thing with the high tax income issue. If you have foreign passive category income being allocated to the partners, whether there's income taxes imposed or not, you still have to attach a separate schedule that shows what type of income it is. If it is subject to taxes, at what withholding rate, right? Either lower or above 15% or not at all. And so because we have foreign passive category income, we have some interest on that Swiss bank account, we're having to do that as well. Now the 8858, this is kind of bizarre. I don't know why they made this a point, but if we're attaching an 8858 to the tax return, we have to indicate as such here, but we don't have to include a copy with the K-3. So this is just letting the owners know that, hey, we do have a foreign disregarded entity in the mix here, and so we filed an 8858, but you're not going to get a copy of the 8858 because all the information that you do need is just going to be reported on K-2. All right, so if we start with part 2, this is where we start to get in kind of the meat of how this is all working. So gross sales numbers, and let me talk about gross sales a little bit in a business context. So when we have gross income for purposes of computing business taxes, it's not quite what you think. Gross income doesn't mean total gross sales. That's gross receipts. Gross income under the code and treasury regs is actually your total receipts net of cost of goods sold. So if you look at treasury regs section 1.61-3A, that's where they define it. So total sales minus cost of goods sold is your gross income for purposes of computing your business taxes. So our gross income at the Swiss level, 392,882, and our gross income in Florida at the U.S. level, 268,112. That is why when we see Part 2, Section 1 here, and we're talking about gross income, we see those balances in the appropriate column, right? So the U.S. of America, United States of America, is the source, U.S. source, sales, 268,112. That's coming directly from our Florida profit and loss. And then for Switzerland, 392,882. So the way these worksheets work, you report the source of the income on the appropriate line. So line A, we're making United States of America. B is going to be Switzerland. If you have other countries that you have income source from, you might add an additional, item C or create additional schedules. And then you move from left to right based on the type of source and category. So in our case, these are U.S. source sales derived from the U.S., so that's pretty straightforward. And then when we have our Switzerland income here, we have to let the user know, okay, what type of gross income are we having from Switzerland? Is it foreign branch category income? In this case, it is. Is it passive income? That's the interest. If it doesn't fall within one of these, it's likely general category income or source by partner. So source by partner, that means that the partnership itself cannot determine source because the type of income is based on the residency of the recipient. So, for example, capital gains or losses. If you sell stock, which is treated as personal property, that is sourced by partner. So if you sold U.S. publicly traded securities, it would be in the source by partner column down here in the long-term and short-term capital gains section. You wouldn't source it either U.S. or foreign based on where the company was based, right? Because the sale of personal property is sourced by partner. Okay, so that's how this is working. So what you can see here is, okay, the gross profit that we had, this is the total amount, and it's being separated into the U.S. and foreign branch category sources. This is important information, particularly for taxpayers like John, because John needs to know the breakout in order to appropriately complete his 1116 if he's taking a foreign tax credit. All right, and so you just take each item of gross income or item of expense, appropriately categorize it, and then source it in one of these columns. So if we go down here to the interest, remember we have interest income that's sourced from U.S. bank accounts and then interest income that's sourced from Swiss bank accounts. So here's the breakout, right? We have United States of America, U.S. source income, and then we have our Switzerland income, $20 of interest, passive category income. So the total there, 86, that's what was reported on the K-1 of the return as a total amount for the whole company. Sorry, let me go back up there just so we can see what I mean by that. Okay, so remember, $86 is the total amount of interest income, right? We can see that reported here on line 5. But remember, by looking at this, page 4, Schedule K, we have no information about what source that interest is coming from. That's why we have to look to the K-2 and the K-3 to get that specific sourcing information. All right, so that's how that item is working. Now, if we scroll all the way down to the second part here, so part 2, section 2 for deductions, same approach here. We're breaking out the expenses by U.S. versus foreign source, and then being more precise within the foreign source section about what type it is, right? Is it foreign branch category income, passive income, or general category income, or some other type of income? The U.S. source expenses, $180,679. If we go look at the financial statements for the Florida LLC, we can see there, $180,679. So that's the total amount of expenses that's being allocated to the U.S. source gross income. And then if we look at the Swiss expenses, we've got $274,591. That's being allocated to the Swiss company. So if we jump back over here, we can see those two amounts, right? $274,591, expenses allocated to the sales income for the foreign branch. And then we have the U.S. source allocation there. Now, once all those are entered, what we'll see, and this is also quite helpful as well, is the net income or loss by source and per category. So we can see there we've got foreign source interest income, $20. That makes sense. That's consistent with what we had on the financial statements. And then we could see here the net income or loss allocated based on source, right? So this is the U.S. source. This is more or less the U.S. source effectively connected earnings, right? And then we have the foreign branch category, the net income here. So the U.S. source piece, that is potentially subject to withholding taxes when allocated to the non-residents. And the net foreign branch income, not going to be subject to any withholding taxes, but again, important for John particularly to know what piece is foreign branch category income, because that is going to determine how he completes his 1116 when he does his foreign tax credits. Okay. Now, if we skip down to part 3, section 4, foreign taxes, right? So if you have foreign taxes paid in a foreign jurisdiction and it is a creditable tax, right? So it was a tax on income, and when it's passed through the partners, they can take a tax credit for it. You would enter that information here, expressed in U.S. dollars. So we have Switzerland, it's an income tax, and the total amount of income tax, you remember, if we look at the Swiss financial statements, is $11,600. Now, the $11,600 was a tax on all of the net earnings here. So the net earnings were the ordinary trade or business income within this company plus $20 of interest. And so what we've done on the return here is we have our total amount, right, there in column G, $11,600, but we're allocating it across the different types of income in that foreign company. So we've allocated just proportionally $11,598 to foreign branch category income. That's the bulk of the earnings in the Swiss entity. And then there's just a measly little $2 there being allocated to the interest income earned on that Swiss bank account. So in the passive category foreign income bucket, we have $2 of foreign tax being allocated to that type of income. Okay? All right, so last section here, if we get down to part 10. Okay, so part 10, this is the fun one. So this is the section that's particularly helpful for non-residents because this shows how the amount of effectively connected taxable income was computed and reported on the 8805. Right, so I'll come back to this screen really quickly. I just want to show us Jane's K1 again. So remember, Jane has $102,862 of ordinary business income allocated to her. No idea, just looking at this number, what portion is effectively connected taxable income from the U.S. and what is the foreign source branch category income. On Jane's 8805, she can see here, okay, there's $43,716. But how did they arrive at that number? What Jane knows is that number, 43,716, is somewhere buried in this, right? So if she did a little math, you take 102,862 minus the 43 and change, and she can kind of figure out what was coming from the German side. But this is where the K3 for her is going to be very helpful. Because if we look at the K2, part 10, so each column on part 10 helps us kind of clarify how the income is sourced and whether it's going to be subject to any kind of withholding taxes on the U.S. side, right? So in column A here, we have the totals, and the totals, if we add up left to right, should be reported in column A. So it's really broken out in two sections. So we have the partner determination. Remember, we talked about the sourcing and capital gains, right? So if we had capital gains or losses from the sale of personal property, that would generally be sourced based on partner. So it comes up to the partner whether or not they would treat that as U.S. or foreign source, generally based on their residency. Now, when the partnership makes a determination, that's where we find it in these columns C through G. So we have this section over here, ECI, so that's effectively connected income, and then non-ECI, so non-effectively connected income. ECI is further broken out into two categories, U.S. and foreign source. Generally speaking, you're going to have U.S. source effectively connected income. However, if you have a U.S. company and they're doing something on behalf of a foreign branch, it can be possible to have foreign source income that's effectively connected with the U.S. trade or business, right? And so that might be something you have in column D here. In our case, that's not what's happening, right? We have an entity that's operating in isolation in the U.S., so we have U.S. source effectively connected income. The non-ECI includes U.S. source income that's not effectively connected with the U.S. trade or business, or just purely foreign source income not effectively connected. So U.S. source FDAP income or U.S. source other income. U.S. source FDAP income would be income that's subject to withholding on a gross basis. So for example, if we had rents, royalties, U.S. source dividends, U.S. source interest that is subject to withholding. Now, what we'll see in our case here is we have U.S. source interest, but it qualifies for what's called the portfolio interest exemption. So if you have a U.S. source that's otherwise FDAP income, but it's not subject to withholding tax, the instructions want us to put it here in column F. So if we just talk about these numbers a bit, $66 of interest income here, report on line 6. This is U.S. source income not subject to withholding, so that's why it's reported in this column. Foreign source interest on line 6, there's the Switzerland interest income, so that's why it's reported on line 6 in column G. If we had interest that was subject to withholding tax, then we could put it here in column E, but that's just not the case given this fact pattern. So the interest one is kind of the easy one. So now we're figuring out, okay, well, these numbers should look familiar up here, right? The amount of U.S. source gross income, so that's sales net of cost of goods sold, that's effectively connected with a trade or business, 268,112, and then the foreign source piece coming from the the Swiss GmbH, 392,882. So the total gross income from the company, 660,994. We can see that number if we look at the not only the financial statements, right? So if we look at the consolidated group here, there's the 660,994. And of course, we can also see that if we jump all the way up to page 1 in the gross profit here, 660,994. Okay, so let me jump back to the K-2. Okay. So that's how those numbers are flowing through on the Part 10 section. And again, this is very helpful information because so this communicates to the IRS two things. One, it shows us that the ordinary income that we have on page 1 of the 1065 isn't all just U.S. source, right? It's separated between U.S. and foreign, and then this further shows them the allocation. So they know that when we file the 8804, there's no need for us to include any of this on the 8804 because it's non-ECI, it's foreign source. This is the only piece, the bucket of gross income that's going to be subject to this kind of withholding tax regime. All right, so that's the gross income piece, and then Part 10, Section 2 covers the deductions. Now, the expenses related to the ordinary income, we're going to find those in the consolidated statements in the total expense line, right? So we've got the $455, $270 in total expenses. We can see that here on the consolidated financial statement, right? It includes all of this stuff here. But the nice thing, again, the purpose of the K-2 is we get to separate out specifically which expenses are connected with the U.S. source ECI and which expenses follow with the foreign source non-ECI. So that number, that's the total amount of expenses coming from the Florida LLC profit and loss statement, and then this one is coming from the Swiss entity's profit and loss statement, okay? And then when we get to the bottom here, you can see the net income or loss from the ordinary trade or business, 205,810. Where do we see that number? Jump all the way up to the, jump all the way up to the 1065, page 1. We can see here we have $205,000, $724 in ordinary. And then if we take that number and then we add that interest income, there we go. Add the interest income here on line 5. There's our total. So 205,810, that's the total amount of income that's being run through the group. And so that's what's being reported on those schedules. Jump back down here to part 10. So a lot of these are, you can look at the numbers and kind of do check figures on yourself. Just make sure that the totals here are making sense with what's being reported on the initial pages 1 through 5 of the 1065, and all of this should start to make much more sense. Okay. Now the last section of part 10 has to do with the gross amounts of ECI versus worldwide gross income. And so this is particularly important for foreign corporations, right? So foreign corporations have certain interest expense limitations. And so if you're doing a Form 1120-F, it's important to know, not only what your allocation of ECI is versus the total running through the entity, but also what are your US situs assets and liabilities. And so in this section, the 268,112, that's coming up from above, right? That's the net gross US ECI, and then the total gross income earned through the entity is, the US and the Swiss piece plus the interest. So that's where we're getting that 661,080. Now the average assets and worldwide assets, if you're a company that's not a bank, when you compute your average assets, what you're doing is you're taking the number at the beginning of the year, the middle of the year, and the end of the year, and you're averaging basically divide by 3. And so that's where we're getting those figures. We pulled balance sheets from the beginning of the year, which would be 0, middle of the year, and then the end of the year, take an average, and that's where we're coming up with those numbers. I won't go into too much detail on those in this video because that computation can get very complicated, and so I'll save that for a separate video. But the same goes to U.S. liabilities. Compute your average U.S. liabilities, so those are the U.S. liabilities connected with the U.S. trade or business, and then directly allocated partnership indebtedness. This is qualified non-recourse debt of which the partnership has none, so that's why that balance is 0. Okay. So now that we've gone through that, let's go. Okay, so we've covered the K-2. So K-2, again, these are the totals reported for the partnership. So now what we want to do is jump into the next video where we're going to go over how these are allocated specifically on the K-3s to each owner and why it's relevant, particularly for those non-residents.